I do want to start where Abigail left off here. The idea that when you look at some of the key measures, whether it's RSI, whether it's 200-day moving average, you can look at some of these major indices and certainly make a case that things have maybe gotten a little bit overbought.
Yeah, it sure seems that way, Romaine. Obviously we've had these unbelievable runs. I mean, the Nasdaq up like 40% and from October, I should say. And of course everything has been so narrow that we worry about that as well. But I think the one of the things too is that we are reaching an an overbought situation where the valuations are getting quite extended. We have the S&P 500 really reaching that 20 times forward earnings and 2.4 times sales. And those are the types of things where you sit there and you say, wait a minute, is the second half of the year really going to be that much better so that these valuations can play catch up? And, a lot of people are talking about a soft landing. Well, soft landing isn't, increased growth. Yeah. And that's really what you need when the market gets as expensive as it is and overbought as it is. So we run into a little bit of a rough patch as we get past the end of the second quarter here.
Well, I am curious about the second half of the year, Matt, and I am curious when you sort of look at the price action in the market, whether you think that is a rally that was on the back of expectations for either a stronger economy or stronger earnings, or was this simply kind of a trend chasing amid all the AI hype and some of the other hype here that it maybe gave folks some short-term optimism?
Yeah, I think it's the latter here. I mean, what have we really seen to see that the second half is really going to be that much better? It's interesting. Really not a lot. There are some things out there. Don't get me wrong. I mean, you mentioned the housing earlier, and of course, consumer confidence has been going up a little bit. But we also see where we're seeing cracks in that area where we have record high levels of credit card debt, and we heard a whole slew of retail companies saying that the consumer is pulling in their horns. But it was what I really think drove this market was the hype with AI and the liquidity injection that went along with it. I mean, you saw what happened with the Fed and injected all sorts of liquidity in March when SVB failed. And we saw that with the big jump in their balance sheet. Then we also had this issue with the debt ceiling, and we weren't issuing any more bonds. That has completely changed. So that liquidity issue, I think, exacerbated and made the AI thing seem much better than it actually is. Kind of the way the internet did back in the late 1990s when liquidity was injected to help the situation with the Y2K. So I guess my point is, if the second half was looking a lot better, I'd feel more comfortable about where the stock market is. But right now, it really isn't seeing that big kind of change. If anything, people are saying it's going to be okay because it's going to be less bad than people were thinking. Yeah. Not that it's going to be that much better.
But that gets to a bigger question here about if things end up being a little bit less bad than maybe thought, but at the same time, worse maybe in the second half than what it was in the first half. Does that mean by default we get a sell-off, or do we just end up in some sort of range-bound status where we hold on to a good chunk of the gains that we've had so far this year?
Well, it's just very hard. I mean, very, very rarely, and I actually can't really find a time in the past when the market gets this expensive, the fundamentals never play catch up enough. The best case scenario is that they meet in the middle. The stock prices come down, or the market prices come down, and the underlying fundamentals improve a little bit. They meet somewhere in the middle. Worst case scenario, of course, is that the economy gets worse and the market really collapses. Not necessarily looking for that. I'm just saying that when you get this kind of a situation in terms of overvaluation, it's just very, very difficult for the economy to play catch up the way that people are hoping for. And again, it's not enough to just avoid a recession when the market is this expensive. If we were trading at 16 times earnings, I'd be singing a different song. But right now, it's just a tough thing to do because history tells us that.